Alex, when you're ready.
Integrated and online, convenient way of shopping, where you can purchase a car with a click of your mouse. Good afternoon, my name is Manet, and these are my colleagues TK and Edwin. Today we'll be determining whether an optimal source of funding for the vending machine project and how you can expand your business accordingly. For our analysis, we'll be looking at the industry that Star operates in and the context of the industry. Then we'll also be looking at different key metrics that are very important for us to determine when looking at the growth potential of your company. For our recommendation, it is to obtain financing from a syndicate of private investors, mainly because you have the potential of international sourcing and also using Calgary as a base of the vending machine project. The impact is that there will be increased sales due to the disruption of the used sales market, which it has not experienced in many past years. So going over our analysis, we'll first look at the economy. Currently, we can see that there's an increase of net worth of households by 7%. However, unemployment has decreased by 4.1%. This shows that there is a lot of disposable income that is present, where households do have the potential to look into different ways of car purchases and also buy used cars. Also, we can see that the forecast for used vehicle sales is forecast to be $1 billion in 2019. The sales projections is very strong in growing economies such as India and China, where the middle class is growing. However, there is a projected sales plateau in advanced economies, mainly due to the used car industry suffering a blow mainly because of the increased technological advancements that are coming in for new cars such as electronic cars. The key takeaway being that there is increased consumer confidence and disposable income drives high projected vehicle sales. Looking over the sales plateau that I initially talked about, we can see that it is mainly driven by increased interest rates and economic uncertainty. There is also a new issue of rideshare traffic being a relative competitor to used car sales, as we can see people using public transportation and also things like Zipcar as their alternative routes of traffic rather than using their own vehicles. This can potentially cause for a decreased sales of automobiles, but which can be potentially mitigated as we'll talk about in the future. In terms of the consumer demand, we can see that consumers generally look for appraisal. They want the vehicle to be a quality vehicle sourced from a quality, free of accidents and sourced from a quality. And also we can see that they look for technological ways of acquiring this vehicle that are fast and also make sure that the entire process is streamlined. For the subsequent changes that follow the sales plateau, we can see that there are certified pre-owned programs in place which encourage the sales of used vehicles, which have grown by 13%. And we can also see that increased process efficiencies, which could potentially be acquired by your vending machine project, can really come into play, especially since there are emerging automotive technologies that your company can take use of. The key takeaway being that sales plateau in the used car industry can be mitigated by an increased focus on process efficiencies and encouraging certified pre-owned programs. Looking at auto lending, which is a main source of revenue for your company, we can see that it is diverse and resilient, mainly as lenders can tolerate more risk because it is worth the reward for them. We also see that a key metric for health and sustainability is the subprime borrowing for you. However, it is down to 18% this year compared to the 19.5%, showing that there is a potential for it to be healthy and sustainable in the future. Also, the average gap insurance coverage has also increased from the prior year from $750 to $850. The key takeaway being that healthy subprime borrowing and increased gap insurance ensures consistent revenues from auto lending, which is one of your main sources of revenue. Looking at the business model of your company and seeing whether the vending machine project can actually play into it, we can see that the e-commerce platform is a transformative approach, as most used car companies involve dealing with dealerships, long contracts that a lot of people don't understand, and also they don't provide a differentiated approach that your company does. Also, we can see that there is lower costs and prices and subsequent prices as there are no intermediaries involved, specifically like dealerships. We can also see that you have 90% positive customer reviews, and you have also taken these reviews into account when creating further products. Also, there is access to proprietary software and patents which gives your company differentiation, specifically looking at the 360-degree view technology that you use to show your companies a virtual side of your car dealership. We can also see that there's 70% of website visitors over the past 90 days for all new users, which means that there is interest in your product, in your cars, and also a new way of showing the cars, such as a vending machine project, can be very useful. So the main question is, how can you really take the traditional order and delivery methods to the next level? Your answer is the vending machine project. We can see that it will be a fully automated car vending machine, which is differentiated due to its efficiency and ease of use. It can disrupt the sales plateau, mainly because it introduces a new innovative technology in an industry that is used to the same old method for many years. Also, there is lower cost opportunities for you due to decreased transportation and logistics costs, and also due to the potential of there being no wages provided if, for example, you would compare to a normal dealership. Also, the Vehicle 360 technology is a patent that you own, which sustains the immersive car buying experience that a lot of customers look for. Due to this, we can see that the vending machine project presents a great opportunity for expansion using existing proprietary software that can disrupt the sales plateau, which makes it a very viable opportunity. The key metrics that we've seen today is that the vehicles used have increased 42% since last year. And for your company, this means that the vending machine project will sustain its growth if it continues the vehicle use increase. Also, we can see that the inventory availability has increased by 19.2%, which you can increase even more if you look at different international sourcing opportunities, which TK will talk about later. And also, the unique visitors to your website have increased 56%, which can increase even more if the vending machine becomes a potential marketing tool for your company, not just a source of outlet for your products. We can also see that the total gross profit per unit has increased by 40%, which has also the potential to increase by the vending machine project by lower costs and higher gross margins. The key takeaway being that increase in various financial metrics can be sustained by the introduction of the vending machine project and international sourcing. Now I'll hand it over to Edwin, who will be going over the alternatives.
So taking a look at our cost assessment for this new vending machine project, we first assume that there will be one machine per building. And with this assumption, we calculated our initial capital expenditure as well as our maintenance CapEx to run this new operation. In terms of the proprietary software, where we know you have the choice of whether to invest in upfront $7 million to have the software developed in a year, or you have the other option of dividing the payments into three years. And the recommendation that we want to give to you is to have this proprietary software developed in 1 year with that initial investment of $7 million. And the reason being is because when we take a look at your current balance sheet numbers at the bottom, we can see that you are really tight on cash, and currently your liabilities exceed your current asset, which indicates that you are reliant on your sales in order to make up for the current liability payments. Going back to our costs, once we converted all our costs to annual sums, we can see that the initial investment for this new vending machine project will cost you around just over $41 million. In terms of the reoccurring expenses, which is the CapEx, the maintenance CapEx, in order to run this project, we are looking at a reoccurring expense of about $30 million. Now that we know that we need this $40 million in order to start up this new vending machine project, and because we know you do not, or you are really tight on cash, so you do not have the cash on hand to fund it with the funds from your operations, we want to look at three sourcing operations. So first, we know you have the option of IPOing. Second option of borrowing from private equity. And third, borrowing from debt. So taking a look at the pros and cons for an IPO. The pros is that there is a potential for large capital injection because you are opening up the market to be able to invest in this new project. Second, it adds liquidity and it makes your securities more marketable. So this is a pro for your current shareholders moving forward. In contrast, looking at the cons of IPO, we wanted to make sure we tailored our recommendation to your guidelines, and we know one of your guidelines is to maintain as much control as possible. So because of that, we did not want to go through, or we did not want to recommend the option of IPOing because we do not want to dilute your ownership and control of management. Now taking a look at the pros and cons of debt. Now the pros is that it is the most affordable capital funding, and with that we see foreseeable cash flow payments because we will know what the interest payments for each year is. And lastly, another pro is that it does not dilute the current ownership of your company. On the flip side, taking a look at cons. Again, to reiterate, because we know that you are tight on cash as your current liabilities exceed your current assets, we know you are reliant on the sales in order to cover these expenses. And because of that, we did not want to take additional debt and increase our leverage because we do not want you to risk potential for default as debt is collateral based. Now, a third alternative, taking a look at private investors. So the pro of this is that it does not impact cash flow like debt because you do not have to make reoccurring interest payments. The second pro is that these private equity investors could come on as advisors. And third, there is not that risk of default, which we believe you should be worried about because your current liabilities exceed your current assets. And now taking a look at cons. Now we know that there is a potential for dilution in ownership, but the reason why we want to go with private investors in comparison to IPO is because we believe that you could negotiate for better terms when going with private investors because you are talking directly to the actual investors and not the SEC or the market in general as a whole. With this in mind, we want to see what the numbers look like when we go forward with a syndicate of private investors. Now, to assess this options financially, we took the current financial statements of your company currently, and we projected the cash flows 5 years down to see what your NPV would be in 5 years. So the first assumption we made is that there will be a 50% growth in used vehicle units as well as wholesale vehicle units. The used vehicle selling price that we kept as a constant as your historical selling price, and the gross margin we increased to 4% and 6% respectively because we know that with this new vending machine project, it will create larger margin for your company because it is a fully automated system. Tax rate, we assume a tax rate of 30% and then a depreciation rate of 2% of sales, making capex of 30 million, which we got from our previous slide, and then we assume a discount rate of 10%. So taking a look at our net cash flows, in the first year, we know that we will require that 40 million of initial capex investment. In the second year, we'll have negative cash flow as we are still trying to cover the cost of our initial investment, and we assume that we will break even in the third year. And our cash flow will be steadily increasing thereafter. Now, after projecting your cash flows and discounting them to an NPV rate with a discount rate of 10%, we can see in 5 years that this project will yield a net present value of just over 350 million. With that being said, I now like to pass it on to my colleague TK, who will go over the recommendation as well as the implementation plan.
Today, our financial team was tasked with valuing whether your investment in the vending machine project was viable, as well as finding an adequate financing option that would fit well with the current position of your project, of your company. We see that your company is still relatively new and it's in its growth phase, and that's why we have recommended that you take on new you take on investments from a syndicate of private investors who will be able to fund the negative cash flows in the first few years of the operation of the vending project. Our recommendation is that you invest in the vending project as it is viable and will lead to bigger returns going forward for your company through the financing of a syndicate of private investors. Looking at our recommendation, we're tasked with three key things. Which investors who should invest in this project, where should we implement the project, as well as where should we source the cars that are going to be within the vending machine going forward. To answer the first question, we looked at our recommendation is to look at a syndicate of investors because it has less impact on your cash flows. We know that financing through debt requires cash flows consistently monthly for the interest payment, and this may be hard for you to reach as you enter a growth phase of the company. There's a lot of capex and investment required to build this vending machine over the next few years and maintain it. Therefore, it may be hard for you to realize those cash flows to pay the interest payments every month. The second thing is that there's no risk of default. As I said before, the monthly payments are in the covenants with the debt offerings that you have been offered. Therefore, and they're collateral based, so a safer investment for you, a safe way to fund this will be going through the investors. The second thing is looking at where to implement this project. And we see in Calgary, because there's more disposable income household within Calgary, other than cities like Vancouver, where the cost of living is relatively higher. Therefore, people are moving to places where they don't need to have cars and rely on the transit system. The third thing is where to source these cars. And we say you should source them from China because, as we have seen, China is offering higher quality cars with a better gross margin. And the wholesaler has offered you 6 months to a 6-month period where they'll be meeting the compliance cost, which allows you to fund more of your growth in the vending machine for the cash flows you'll be saving from there. So taking a deeper dive into these two key factors, we look at the first thing is where to implement the project. And there's more growth potential for your project within Calgary as more people need the cars to travel, as opposed to a city like Vancouver or Toronto where there's transit systems that are already adequately in place. The next thing, we'll be looking at where to source the cars. We say you should source them from China because there's a higher operating margins and a higher quality cars as compared to the US and to Mexico currently. Mexico is offering cars that are rated 2 out of 5, and this is not good for your customers as they'll be getting subpar cars and you'd have to pay an extra amount for the compliance tests that are needed for these cars. With every recommendation, there is need for a strong implementation plan for it to come to fruition. And our implementation plan comes in 2 stages. First is the short term, which is the due diligence you need to do and the R&D you need to do until we're finding a place to invest within Calgary and build the vending machine. The second thing will be the search for investors. And the third thing will be contracting the development companies to get an actual quote of how much it costs to build this, as well as the feasibility of it within the areas in Calgary. We say that you should sign the contracts with your investors as well as the developers in the fourth quarter of 2019, and you should apply to patent this technology and protect it, as it is a new and innovative way to be selling cars. In the long term, as we've been starting with the beginning of 2019, we see that you should be starting to build this vending machine project, as well as testing the prototype in 2020, as it takes about a year to build. So testing of the prototype will happen in 2020. Launching will also happen in 2020, and then we advise you to monitor and monitor the performance of the vending machine and monitor key metrics as to how many people are actually buying from the vending machine and get that customer feedback going forward. With every recommendation, there's also some inherent risks with it, and we've identified 3 key risks. As can be highlighted on our heat map, the risks that are in the red zone are high likelihood and high impact. The first risk that we've identified is the operation, is how people are now opting for new cars. This is to mitigate this. We see that you can use your vending machine as a marketing tool and to lower down the cost and results in the lower prices. Due to the time, we're going to rush through the slides just to get to the key points that we have. The second risk will be the slow go-to-market, and we advise you to have a shorter development strategy of this project by taking the $7 million that allows you to build the project within 1 year. The third risk will be the geopolitical risk of sourcing cars in China. And to mitigate this, you can still have supply from the US going forward. Once again, we tasked us with finding to determine the optimal sourcing of financing for this project. And our recommendation is that you source it from a syndicate of investors and look for international sources of your cars, as well as starting the project in Calgary. Thank you. We open up the floor to any questions you have.
Our judges, you have 5 minutes for Q&A. When you give your first question, I will give it time. The financing option from Garcia Trust, the 25 million, which we have proposed, seems like a key part of it is the convertibility and equity. So basically, that would mean that's probably a deal breaker. How would you address that?
So because it is with an individual investor, we believe that we will have a better probability in negotiating more favorable terms in order to keep as much control, keep as much ownership control as possible with you. So with that being said, we're confident with going with the private equity investor.
And I have business in your presentation, but what is your proposed sort of structure to collaborate with Vehicle 360? The case says there are 3 options. You either collaborate with them, or purchase them, or you invest in them.
We believe collaborating with them personally, because we have had a continuous relationship with them. We believe that collaborating with them and continuing this relationship will provide us with a basis of actually creating a foundation, strong foundation with them. This also means that we might be able to in the future, if we do see the cash flows from the vending machine, from their specific technology, that we might be able to invest in them in the future.
And based on the recurring costs that you guys have outlined, how many units do you think we would need to sell, especially in a market like Calgary, and what that absorption rate would be in order to break even?
So we projected your current financial statements 5 years forward, and with our assumptions of 50% growth of unit sales over the next 5 years, we do foresee that we will break even in year 3. And going back to our financial, we didn't include it in our slides, but as you can see, we will break even in 2021 with cash inflows of 60 million.
Are you going to stop at 1,000?
So our plan with Calgary is to pilot the project. This is the new project and a new way to be entering the market to sell used cars. Calgary would be our pilot phase, and we see that there's room for international expansion with this. If we see that success in Calgary, which we predict.
Where would you go next?
The next place we go is within the emerging markets such as China and India. As we can see, there's a high growth potential in terms of people buying used cars. What we've seen in countries such as in North America is that people are now more opting towards newer cars, and we don't see this trend in other countries, and those will be the countries that will be most ideal for the business model.
The U.S. is 90% of vehicles. Why are you avoiding doing the towers in the U.S.?
We believe the sales plateau in the U.S. might be a deterrent for our growth strategy. Therefore, we do believe that emerging economies where middle class is the middle class might be a better option in the future. However, we do believe that Calgary pilot phase will give us better indication and information, relevant data, which we could potentially use to determine which our future geographical locations would be.
So one would be tempted to say, sales growth has been excellent over 3 years. It's gone up 6-7 times. Margins are increasing every year. You're seeing economies of scale. Why do the towers, the vending machines there?
So the vending machines provide you the new opportunity to get to your market, as well as there's the opportunity for you to expand, even to go to car sharing as a new business line through these vending machines. So instead of having a lot of dead weight just waiting in the vending machines, you'll be able to also rent these out for short term, and this will also increase the revenue that you get from the towers. The towers also save you with logistical expenses from the delivery of cars that you have to do currently from your depot. So having them in a centralized place where people can actually go lowers your costs logistically, as well as the wage costs that are involved in transporting these cars.
Just to hit on that point around the plateau, yeah, you're only in one tier 1 market right now in the U.S. You're doing nothing in Chicago, Atlanta, Dallas. Why do you think the plateau?
I think some of the reasons for used car sales plateauing is because there are those introductions of car share programs as well as increased capex from the government in public transportation system. So with these increasing over the years, we can see that there's an incentive for consumers in general to move away from owning
Q&A
or
is
car
finished.
ownership.
Thank you, delegates. You may leave the room.